Ladies and gentlemen, do you know that $780 trillion flows through our economy every year? That is about 74 times the money that flows through the gross domestic product, which is the part of the economy that we are a part of, including the businesses that produce the products we use and the costs of all our federal, state, and city governments. Today, we take out about 23% of our $10.5 trillion gross domestic product in taxes. Compare this with Mr. Anderson's proposal of taxing only 1% of your money flow. How can this be done? By taxing, after some exemptions, $447 trillion of our money flow instead of just the $10.5 trillion gross domestic product. From this, we can only conclude that most of the money flowing through our economy is not paying its fair share of taxes. Let us go back to when Mr. Anderson first proposed this idea to the politicians in Rhode Island as a substitute for real estate taxes. The politicians liked it so much, they allowed him to obtain the money flow statistics of the state of Rhode Island. However, when the politicians realized it meant taxing the money flow of insurance companies, lawyers, bankers, and stockbroker fees, that was the end of this idea. It was also brought to his attention that people would do their banking in another state to avoid the tax. Mr. Anderson shifted his attention to taxing the money flow of the U.S. economy. He wrote a thesis on levying a 1% tax on the nation's money flow and sent it to Congress. After a short time, Mr. Anderson received a copy of his letter sent to his representative in 1984 by the chairman of the Ways and Means Committee of the House of Representatives. The chairman pointed out two faults. One, an integrated corporation would have a tax advantage over a small business. And two, notes that matured in 2 to 30 days would not earn enough interest to pay the 1% tax. After thinking about this, Mr. Anderson came to a conclusion. We could tax the money flow of each type of business, such as mining iron ore, oil wells, steel making, manufacturing and wholesaling, and retailing the finished products. Now, as this tax had been levied at each step, the integrated corporation would not have a tax advantage over the small business. The problem of the short-term money market would be solved if we exempted notes that matured in less than 6 months. You may ask, how does Mr. Anderson know what the money flow is in our economy and other statistics? Well, he obtained this information through the courtesy of the Federal Reserve, a booklet published by the Bank of International Settlements in Switzerland, showing the amounts and the various types of money flowing through our economy, dating back through the different years. Mr. Anderson had to use the year 2002 to get a fair comparison between government expenditures and the nation's money flow. This booklet showed that $781 trillion flowed through our economy in 2002. It also showed that we had $687.6 billion in currency circulating in our economy. This would have to be exempted, of course, as it would be impractical to collect a tax on people's transactions using currency. We also would have to be exempting about 339 trillions representing clearinghouse, short-term money market, rollovers, etc., leaving about 447 trillions to tax. A 1% tax on this amount would bring enough revenue to support all of the expenditures of our cities, states, and federal governments, including Social Security. Compare this to 23% of our gross domestic product we take out now in taxes. This huge difference must make one think some part of our economy is not paying its fair share. How are we going to collect this tax? Very simply, as people and corporations deposit their money into their bank accounts, a 1% tax would be deducted automatically by computer. At the end of the day, the total amount collected would be sent by the bank to the tax bureau. In today's economy, where everyone uses credit cards, checks, and direct deposit, it has become practical to require by law that everyone, corporations, mutual funds, insurance companies, stockbrokers, trusts, endowment funds, banks, lawyers, doctors, and all types of businesses have a deposit account at some bank so this tax could be collected. The use of a bank in another country to avoid this tax would result in one's losing their license to do business in the U.S. An individual person would have their assets and bank accounts frozen until what is owed is paid, plus a 20% penalty. By law, everyone would have to pay their employees and suppliers through this banking system. To discourage the use of cash, there would be only 1, 10, and 50-cent coins and $1 and $5 coins. No paper money. Coins would be obtained from ATM machines and the banks for use in vending machines and for cash transactions. Churches would be exempt from this tax except for their investment income. Of course, we would need revenue agents to make sure everyone was paying their employees and suppliers through the banking system and not doing their banking in another country in order to avoid the tax, and for checking the banks to make sure they are sending the correct amount of money to the tax bureau. Now, with a credit card economy, fraud does come to mind. We could have a credit card with one's picture and signature on one side and official information on the other side. At the cash register, one could place their thumb on an email device so it could be sent by wire and be compared to one's registered thumbprint at his or her bank. No thumbprint would be on the credit card, so it couldn't be copied. The banks would have to charge for these cards and guarantee payment. However, if one did a lot of business with the bank, it might not charge anything. Now, transferring money from one account to another or to another bank would be exempt, providing it is the same amount of money and going into the same person's or corporation's name. Now, during the last